All right, hello everybody, and welcome to this Monday market breakdown. We'll get started here, jumping right into the S&P market overall. Pretty nasty day on Friday, and for that to happen after what looked like a kind of a breakaway here to new highs, right? We did actually notch some new closing highs, or at least one new closing high here. It certainly looked as if on Wednesday and even Thursday after the pullback looked like we were headed higher. So the failure to hold that and have such a nasty Friday, which by the way, these Fridays are, we've had a couple doozies on these Fridays, right? But anyway, nasty day. You can see this trend line of support on the S&P that we are monitoring, right? Tested 3 times, took that out on Friday, held. Now, I know this is hard to see, but you see this line that I've got highlighted here. Follow that along. That 50-day moving average is where the S&P tried to hold. We don't think that's going to hold. Nothing about Friday's drop looks like a drop that's over. Although we do want to be fair, we're in a bull market and bearish things tend to fail more often. So we have plenty of examples. Like here, nasty day that was dangerously close to the low. It was the closing low. Had a nasty day back here that we just reversed. Nasty day back here. Everything about this looked like lower, and each one of those we popped back. So certainly want to give the market the benefit of the doubt. We are in a bull move, at least as of right now. But do remember, at the beginning of the year, we talked about some of the concerns we had been highlighting at the end of 2024. We had talked about the top-heavy nature of the market, okay? More top-heavy than it had ever been in history, okay, as far as fewer and fewer stocks doing more and more of the heavy lifting. Okay, doesn't mean that only a handful of stocks are going higher, or that weird narrative that the bull cheerleaders like to make up, right? Nobody worth their weight is actually saying that. What they're actually saying is that there is a fewer number of stocks doing most of the lifting, right? And that is simply a fact. That's not anyone's opinion or anything, right? When you get in those environments, okay, that doesn't tend to be good for the market. We've talked about, again, everything from the uninversion of the yield curve, you name it, right? Well, one chart worth revisiting today, because this became pertinent again last week. Okay, we showed this one, okay, and different variations of it. That the conventional wisdom, so to speak, is that when the Fed starts cutting rates, that's good for the market. And as you can see here, historically, that has actually not been the case. Now, you don't need any chart, okay, to know this. Just think about it. Think back if you've traded, like say, for example, through the financial crisis. If you traded during the dot-com era, you probably remember that you start cutting rates when things aren't going well, right? To boost things, to juice things or whatever, right? And look at what just happened through 2022 and 2023. We were raising rates the whole time. What's the market been doing? Going higher, right? So you don't really need a chart. You don't need anybody necessarily to prove it to you. It's just we're living it, okay? But you'll notice, and this is why we started talking about it last year when the Fed started cutting rates, okay? We said, hey, look, that could be a problem for the market, not a good thing, okay? And what you'll notice from this graphic is that 3 out of 4 of these times, or 2 out of 3 of these times, it was there was a lag, right? It was still several months before the market finally peaked. All right. Now, why am I bringing this back up? Because again, notice that once rates and yields started to decline, that was actually bad for the market. Bad things happen, not good things. All right. Now, keep that in mind as we go back and take a look at the TLT, right? We put a long-term trade on this, okay? And let me show you why. First, let's pan out to big, big, big picture, okay? One of the things we've always talked about, we've been talking about for a long time on the S&P, okay, and how we were able to forecast some of the more recent bear markets and corrections, okay, is momentum divergence, specifically negative momentum divergence, right? When we see price, this is a monthly scale. This is very large. Okay, we wouldn't make any kind of major call on like an intraday chart because it's not, it's small. Who cares? Okay, we're not going to make a major long-term, call on a short-term time scale. This is long-term, so this is monthly, right? And monthly divergences, the negative divergence where we go on to hit that new price high but lower momentum high, new price highs but lower momentum high, new price high but lower momentum high. So it wasn't too terribly difficult for us to call the 2022 bear market correction. Okay. Well, if you look here, S&P sure looks like if February finishes lower, and especially if we continue lower into March, we're going to put in a lower peak, okay, compared to this one, okay, while we put in a higher price peak, okay. Some even worry about the fact that we had these high peaks, lower peaks, and now maybe even lower peaks, that maybe we're seeing a generational divergence. Time will tell, okay. But with that being said, let's flip back to the TLT. A positive monthly divergence. Okay, look at the low here on the RSI corresponding with this low in price. But look at this lower low in price, higher momentum trough, meaning we weren't as weak this time down. Okay, this is this momentum, positive momentum divergence was how we were able to call, the one of the ways we were able to forecast the potential that the bear market low was in 2022. Okay, so in TLT's entire history, it has never put one of these in, right? So this is kind of how rare these things are and why we definitely want to pay attention to them when they form. It implies the TLT maybe having put in a long-term low. Now we want to see price confirm these types of things. We're not just going to make trades just based on it, right? But you'll see here's the TLT down channel from last year. Once we broke out of it, nice run, from down in the low 90s or around 90, clear up to 101. Okay. Well, you're going to notice on Friday a breakout of this channel. Okay. So combine this with what we just looked at. Sure looks like the TLT is running higher for quite some time. What does that mean yields are likely going, or are going to do? What are they going to do if the TLT is running back to this high and maybe even higher, right? When we pan out, we say, all right, where do we expect to go? Well, first we expect to get back up into this range, this area around this 100 to 102 zone. So we think we get there. And if you take that out, which we would expect based on that momentum divergence, it implies something different this time than we think we're getting up here, maybe even back to here and beyond. So what would yields do in that environment? And what did we just look at the market might do and, or commonly does, we'll say, in that environment? All right, so just some things to keep in mind here, right, as we look at last week's move and what do we think of it? Well, we think it is certainly possible. Odds are, raised a little bit that a meaningful high may have been put in here. Now, we're not going to get too cocky about it because we want to see price confirmation. What would that price confirmation be? Well, let's go back to the last momentum divergence that we called, and that was back here. Okay, the S&P had put in this nice channel, okay? And this is the end of 2021 going into 2022 where we saw that last momentum divergence. Once we broke out of this channel, that's when we say, okay, if that divergence is going to play itself out to a 20 to 50% correction of some kind, this high should hold. And it did, right? Well, look at this big channel here that we're monitoring, okay? So that's what we're going to keep an eye on for now. We can take out this low. That should confirm the negative divergence on the S&P, put that with the positive divergence on the TLT and what that means yield should be doing, and we could have very well seen a high. Now, do keep in mind, there's nothing saying the S&P couldn't run up to new highs and everything I just walked you through not still hold. Remember, this is daily, right? We can run higher for some days or some weeks. Those were monthly creations, right? That's a monthly scale, so they wouldn't necessarily change. So we'll update it as the weeks go on and months or whatnot, but just want to make sure everybody, as we said at the beginning of the year, I said it once, I've said it 100 times, it feels like since the beginning of the year, be careful out there, kiddos. We don't go up forever. There's always another correction around the corner. We put this bottom in over 2 years ago, a nice healthy correction, or maybe a little mini bear. Shouldn't shock anybody this year. As a matter of fact, I'd be expecting it as opposed to not expecting it, right? Now, a couple stocks we'll look at real quick. Home Depot is one we're watching. Okay, the break from the 400, we felt that would fall to 380. Here we are today, hitting the 380. Look at this head and shoulders pattern, right? Take out that 380, which we think we're going to do because of this trend line that goes back a couple years. Okay, so if we're taking out that trend line, that implies that we're probably going lower to some extent, although by definition, it could just mean change of trend. But that change of trend should involve some sort of decline. Well, as you can see, we're taking that out. We take out 380 as well. It's confirming this head and shoulders. It implies a long way to go, at least back down to this low. Okay, so Home Depot is setting up, and this goes hand in hand with a lot of the housing indexes you may be seeing out there that are showing a similar topping process. All right, so, and by the way, housing tends to lead some of the rough patches in the economy. A lot of things lining up here this year, folks. So I can't stress enough, be careful, right? Another stock, they have earnings, so there's not a whole lot we can do with it, but Kava breaking down, moving lower today, no real shock. We really wanted to get short this last week, all right, after it broke this 110, and we'd be pretty happy about it had we done it. The problem is it has earnings this week, so premiums get a little high, but some people have different strategies that they like on an earnings play of some kind. We tend to stick with long-sided plays, so yeah, we stay away from it, but you can see this breakdown of 110 should mean lower. And then last one we'll look at here is Tesla, right? Rolling back up, never could take out that 360. Just couldn't. Tried Wednesday, failed, came right back to 360. And now here we are rolling back over. We're watching a few things here. We're watching this line back here, right around 310. We're watching the bottom of this potential channel slash flag, right? We got top side tested a few times, but only once here on the bottom. So we're not going to get too crazy with it. But we don't see any reason that Tesla couldn't be down at 270 here, this old breakout point. And if the market is going through a rough patch here in the coming weeks and or months, every reason to believe that could happen. All right. So the bottom line here, folks, is we're encouraging everyone to just kind of right now. It certainly seems as if the down is the place to be looking. If the market gives us a reason to change that view, then we will, and we'll update it next week. All right. Otherwise, until then, everybody, good luck in the trading. See you next week.